Welcome, everyone, to the webinar on U.S. elections and financial markets. My name is Guillaume. I'm going to be your presenter for today. 60 minutes, you'll have the opportunity to learn how we can help you navigate market events and improve your long-term success as an investor. The agenda for today is we're going to follow 5 topics: a history of market ups and downs, the market returns pre and post-elections, a review of the current market environment, how we can position our portfolio based on evidence, and 5 principles of what it takes to be a successful investor. The team, so I am part of a team called Mellon Wealth. We are across the country. Sam Lightman is based out of London, Ontario. He's the founder. He's an amazing financial planner and extremely hardworking and dedicated individuals as it relates to financial planning and servicing clients in what we believe the right way in Canada. Munish Mehan, former engineer, amazing background in insurance and very knowledgeable about insurance and corporate-owned insurance, and brings a whole suite of expertise regarding to planning. And then myself, which I'm going to cover in the next slide. So various background, just to give you a quick insight on who I am. I did my BCom Bachelor of Commerce at UVic. I'm based out of Victoria, BC, in case you're wondering. I'm on the island. If you're ever visiting the island, don't be shy. I did my CFA, did my CMT. I also passed my CFP, Certified Financial Planner exam. We're all financial planners here at Mellon Wealth. And then as far as experience, I started at Questrade about 9 years ago. I spent 2 years there working with retail clients. So I've learned everything not to do and how to manage money, and through people and through my own experiences as well. And all the mistakes that we make as investors and individuals. And then I moved to a company called Thomson Reuters, which is a financial technology company. And that was a unique role because I got to get exposed to financial professionals across the country. Portfolio managers working at pension funds, large asset managers, institutional trading desks at banks, the central banks of Canada. Like I was covering these clients, and I was able to see their role and what they were focused on through the data that they were buying from us. And then I had a quick stint at a private family office. I was working for a billionaire, and it was quite interesting. I wasn't there too long, but I learned how people with a lot of money are deploying capital, and that was just a very insightful experience. And I took a lot of great things from that experience, although it wasn't the long-term career path that I was looking for. And then here I am, a financial advisor, investment coach, financial planner, servicing retail individuals across the country under the trade name Mellon Wealth. Where you can find me, I'm all over social media. LinkedIn, Twitter, TikTok, Instagram, YouTube, and I'm relaunching a podcast on Friday, so stay tuned for that. It's called the Optimized Living for now. Don't overthink the name; it might change in the future. But if you want to tune into the content, the goal is to help you make more informed decisions in your investments and financial planning strategies. So if you want to tune into this content, you can find me pretty much anywhere. Just a quick disclaimer. So I am a mutual funds and ETF licensed. I'm also insurance licensed through PPI Solutions. And we provide financial planning services as well, which are distinct from Portfolio Strategies Corporation, which is our dealer. Perfect. Let's dive into it. So a quick history of market ups and downs. And so we'll mainly look at the S&P 500, given that the U.S. election is happening in the fall. And let alone what happened in the last few weeks with Trump indictment and whatnot. And let's see how that turns out. But we're definitely set up for an interesting fall for sure. And given his large following in the U.S. But let's look at the S&P 500 over the last 9 what we qualified as bear markets, or at least the most important bear markets that are highlighted here. What I want to point out is where we stand versus history. So right now, if you look at the pandemic, which was one of the shortest or the shortest out of the 9 by far, we are 4 years in and we're up 151%. We haven't completed the 5-year. We have one more year to go. But again, it's not far-fetched to see that maybe next year we could tie up, the global financial crisis as far as a 5-year recovery, which would place us in like the third fastest recovery of these 9 identified bear markets here. And then if you look at the inflation spike that we saw in 2022, which brought markets down, both equities and fixed income, we're already up 51%. And we still have 3 more years to go. So all this to say that it's interesting to see how much of the recovery we've recaptured already, given the events that we've gone through. Now, looking a bit deeper into the bear markets, classifying them as 20% or greater since 1929, so almost 100 years. The fascinating stats that I find in this table here is 9 out of 16 bear markets since 1929. The investors who stayed the course made back their losses within a year. This is over a 50% average to make your money back within a year. And the reason why I'm pointing this out is that hopefully this is bringing you peace of mind that even if you're facing a 20% decline, you still have a fairly high probability that you may recover all the losses, if not more than the losses within a year, which is extremely short in relatively speaking. So whether you're approaching retirement or in retirement, this hopefully can bring you quite a bit of peace of mind. And then, of course, no one can reliably predict, the magnitude of the decline and the time of the recovery. And we'll see through a few charts today how trying to do that is usually hurting you more than it's helping you as an investor. So let's look at the market returns pre and post elections. And I thought this was a fascinating stats for a few things. So the average return during an election year is 11.57%. And the average return the following year is 10.6%, so a bit lower. The S&P 500 is already up 10.5% this year. But what I want to draw your attention to is we are supposed to expect a lower return the following year of the election, right? That's what the stats shows historically. But over the past 4 elections, the following year of the elections have vastly outperformed the year of the election. So you have to go back to 2004 to see this assumptions playing out, where the election year was better than the following year, regardless of who is, we've had Republicans and we've had Democrats. So it's been 4 in a row. So if this happens again, and we're already up 10.5%, if we have a strong year this year, and next year is even better for, depending on, different macroeconomic environment we're in and whatnot, that could be the 5th times in a row where we're seeing better results the following year of an election than during an election year. Or maybe we have a reversion to the mean and then that actually plays out. But regardless, I think it's interesting. I also think it's interesting to see that when you look at the 3rd years of the election, this is where things get dicey. For example, in 2020 was the election. 2021 was a good year. 2022 was a rough year. 2016 was the election. 2017 was a great year. 2018 was a rough year because that's when they were also raising rates. And there was a lot of talk about, this going haywire as they were raising interest rates and markets spooking and whatnot. If you go back to 2012 was the election, 2013, and then 2014, 15, we were facing, the oil crash and whatnot. And then 2008 was the crash. 2009 was a great year, but 2010 to 2011, European markets were facing a debt crisis, and that was spooking, markets globally. So the takeaway from this, and I'm pointing this out in this slide because I want to come back to it in a few slides from now, is going to be interesting to see if the good times are going to continue. But in Canada specifically, I just read a stat this morning where 75% of mortgages are due to renewal, by the end of 2026. And this is the ones that, as of February 2024. So it's going to be very interesting to see what's coming up ahead and when we're going to see some increased fluctuation, some downside movements in the market over the next 2 years. Well, I'm digressing here. Okay, let's move into the next one. This is to show you the average return for U.S. presidential elections, so about 9.5%. And you can see different by president, what was their average return over their term. I'm sure Trump is quite happy to have beaten Obama in terms of average. And then who knows who wins in the fall, but another Trump presidency could it be also very positive, or could we see maybe a reversal? Who knows, right? But then I have a question for you. I don't know if you're in the chat. Can you tell me, by looking at these slides, which 3 presidents in the history have not seen a recession during their time in office? But yeah, the 3 presidents that have not seen a recession within their lifetime: Johnson, Clinton, and Biden. Those either came right after, Biden, for instance, came later in 2020, and that was the shortest recession. And then someone like Clinton, he came in the early 90s, but then just left, technically before the tech bubble in 2000s. And then one that hit the 2 recession was actually George W. Bush, when he came in the tech bubble and retired in the financial crisis. So I don't know. I just thought he's definitely had a rough time in the market, as a president, when it's looking at market returns during his presidency. So let's review the current market environment. There's a number of indicators that we can look at to assess where we're at in the economic cycle. One that has been, and most people will use a combination of different indicators. There's hundreds of different macroeconomic indicators that you can follow. One that I think is simple, but also summarizes the picture, is the leading economic indicator, LEI index. And there's 10 components of it. I'm just showing you the components here, not necessarily the intricacies of where they're at. I'm going to show you a chart afterwards about them. But there's 3 financial components, and there's 7 non-financial components. And we're going to go through the 2 of them: the S&P 500, which we've been looking at, and the interest rate spread between the 10-year and the 3-month Treasury bill. The reason why I'm showing this is because this is a leading economic indicator, and it has the S&P 500 index in it. Because if you believe that markets are mostly efficient, markets will be able to predict in advance it's going to sniff out the health of the economy and everything that is around, that is impacting the economy. And every factors impacting the economy should be reflected or interpreted by market participants, which also should be reflected in prices. So when you're trying to predict where market's going to go, you're basically trying to predict the thing that is also predicting the economy itself. That's why it's extremely hard to do, because when you look at it in itself, that should dictate what the future holds. So if we see higher prices going up and you still have a strong momentum, it's just because everyone is piling to the trend, or in the belief that there's good times ahead and whatnot. And that's why we've been seeing so many all-time highs recently. I'm digressing here. And then we'll look at the interest rate spreads and what can we learn about the fixed income curve and how it's shaped as we speak. So if we look at the indicator itself, the reason why it's quite an interesting indicator, and also why people have paid attention to or I've tried to predict recessions with it, is because, as you can see, it bottoms either throughout the recession. Again, recessions are always identified in hindsight, so they're kind of useless while it's happening. The indicator is going to bottom, and then afterwards they're going to declare that, oh, this was a recession. But when you look in hindsight, you can see that it's not perfectly leading the economy, but when it declines, afterwards a recession is declared and whatnot. The problem that we've had, or the not problem that we've had in 2022, is it's the recession that never happened for whatever reason. I'm not going to speculate on this. The point is, technically, this is already is reversed. And as you can see, you can just see a trend as far as when the indicators are picking up positively. Then, as you see, historically, it's been the bounce back or the recovery from the recession. So it's just a very interesting time. That's why people were so pessimistic, because the data might have been pointing towards the fact that we were heading into a recession, but technically we've never really had it. And that's where it's important to notice or to focus that, do you want to be right or do you want to make money? If you follow the data and it's pointing you to something, but the market prices are reacting differently, it's important to focus on the market prices and how you invest, but not trying to be right by looking at the data sets that is pointing you to a certain conclusion, because there might be a mismatch between both. And that's what we're seeing. That's what we've seen. Now, if we look at the US equity market, this is what I wanted to show you earlier, where the past 4, we've had better subsequent year. And here we are again, and this was pulled on May 30th, which is higher now. But again, we're again at all-time highs. And who knows what's in store, not only for the rest of the year, but for next year. Or will we see a reversal? That's the question. No one knows. Now, if we look at global equity markets, one thing I wanted to point out is everyone is talking about the S&P 500 and how great the US is, but no one has called me to ask me to put more Sensex into their portfolio or have increased their exposure to the Sensex exchange. By the way, I know you guys are pretty quiet on the chat, but do you know where the Sensex exchange is from? Which country is tracking? It's India, actually. So believe it or not, like it's especially during COVID, you've seen a very strong divergence in global markets, and India, United States, Japan, Taiwan have really exploded since March 2020, which I think is quite interesting. Which is going to tie into the principles of a successful investor is not many people are actually exposed to these markets. And given that most people are concentrated even in their own country or the S&P 500. Now, looking at the fixed income market, this is interesting. This is the 10-year yield minus the 3-month Treasury yield. So in a normal market, the yield curve should be upward sloping. So shorter yield should be lower than long-term yield. The problem that we're seeing right now, and this is over the last 35 plus years, is that as we speak, it's one of the most inverted yield curve that we've seen. So 3-month are higher than 10 years. There's only one way to go from here, and it's a re-steepening of the curve. And that's what we're seeing today. The Bank of Canada they're the first in the G7 to cut their interest rates by 25 basis points. And they're just the start of many central bankers who are going to probably follow in lockstep, over the next 12 to 18 months, for instance. But the whole point is the only way to go from here is re-steepening. What's challenging is if you notice at like the historical patterns of this, as you go towards a recession, so just before a recession, like the economy usually has been picked up, inflation is higher. That's why they're raising interest rate. They're raising interest rate because things are heating up and they're trying to cool it down. So that's why you see this inversion. So by the time they start cutting rates, they're usually not cutting rates because things are amazing. They're cutting rates because like inflation is cooling down, or the economy is slowing, or like there's a changes in the macroeconomic environment that is forcing them to ease up in their policies. So that's where it's interesting to see, okay, if they take this approach, how are equity markets, fixed income markets, and other global markets, like how will they react? Because there's a lag to that. Yes, they may start cutting early, but that doesn't necessarily mean that it's bearish for equities and whatnot, right? That doesn't mean that like the bad things are imminent to happen. There might be a lead lag to that, which is reinforcing the comments that I've made about maybe this year and next year, but then again, the third year, this is where we might see some downside movements in global equity markets specifically. So the Canadian story is the same. Again, same inversion that we're seeing. And it's just to see, like, it's just interesting to see the deepness of this inversion over the last like 35 years. Now, the question is, okay, when are rates going to be cut? And this is all free data, by the way. You can use that on all public sources. But I always find it interesting when the news, like they're latching onto those events like it's a sporting event. But in fact, like you can just look at the probability like on every single day of every single month, depending on where the market is trading. And right now I just pulled up like, for example, the September meeting. And then you can see that we've already have a 25 basis point priced in of a cut. And then if you pull, let's say December, and then as we approach these events, the probability will shape themselves. And then as you get closer to the events, you'll have a really good idea of like what the meeting is going to be, whether it's going to be a cut and how much of a cut. Because most likely what's happening is central bankers, they'll always follow the market. The last thing that they want to do is spook the market. And if there is a certain, especially when you look at 50, 60, 70%, there's something is priced in, they're usually going to follow this. Now, they might have a different reasoning, but it's just the market is pretty efficient and at sensing those things. This is the US. Canada is a little bit off just because it's, and I'm not going to go into too much detail, but essentially this is looking at the September contract as well. And now it's looking at a 50 basis point cut. We already had 25 today, so it's not far-fetched to see another 25 coming along. So between both Canada and the US, who knows where we're going to end up at the end of the year, anywhere between 50 to 100 basis points down is not too far-fetched. So now the question is, okay, how do I position my portfolio in order to navigate those events, which is also, which is one of the main takeaway from this presentation. I want us to look at like two scenarios. Scenario one, and the reason why I'm showing you those two scenarios is because when people come to me, there's two things that they always ask, right? What was the past returns and what's the cost? That's usually what people really care about. And when you just look at past returns, it's a very misguided approach to investing, but everyone does it. Even us as professionals, like we look at different model portfolios and we're always going to put like the last 10 years, last 20 years, like last 100 years, if we use indexes, we're always going to look at past returns. That's really all we have. But past returns themselves are not enough to make investment decisions. And I want to prove the point here today, which I took from a training session I've had in Toronto a couple of weeks ago. So scenario one, those are real scenarios, by the way. So scenario one, when we look at the returns from January 2000 to December 2019, if you had to look at investment A versus investment B, and you have to pick one of either or for the next 20 years, which one would you pick? Right, it's not a trick question. Perfect. And then now let's look at the data set, but all we do is we extend by 3 months. So instead of looking at January 2000 to December 2019, we look at January 2000 to March 2020. Now look at the returns, investment A or investment B. So if you had to look 20 years forward, which one would you pick? Just looking at returns. You'd probably look at investment A, right? In scenario two. So in scenario one, you would pick B. And then scenario two, you would pick A. Just by looking at that, right? But now let's look under the hood. What is investment A and what is investment B? And I thought this example this is real data. The investment A is the US aggregate bond index. And the investment B is the S&P 500. So in scenario one, when you picked B, as far as, okay, I looked at past returns and they were higher than A, so therefore I should pick B, and that will carry me for the next 10 to 20 years. If that was your decision to invest your money to retire, this was the right decision because equities outperform bonds over long periods of time. But if you just look at a different time period, and that's the whole point of this example, is that the time period is so specific you need to be very careful when you look at the time period to make investment decisions. Because if you look at scenario two and you did the same approach and you say, oh my God, investment A looks better than B, I'm going to put investment A for the next 20 years. And that was for your retirement, you would have put all your money in fixed income, which are totally different asset classes, totally different return streams, totally different volatility. So return themselves are not enough. They're not meaningless, but they're like a small part of a sound investment approach to position yourself for longer, for better expected return going forward. You really need to understand what's behind the numbers and the methodology that drove and the approach that drove these returns, which is my segue to what are the 4 sources of expected return in the equity market. There's 4 parts that you can break down the market in pieces and you can expect to quote unquote outperform. And this is well documented and well researched. Let's look at one each separately, and then we'll go into a few more examples in as it relates to each of them or some of them. So the premium one is equity outperformed treasury bills. That's pretty obvious when you look at something that is guaranteed. Think of it as like a short-term GIC in Canada. That's very low risk. That's guaranteed. So if you invest in equities, you should expect much higher returns over the long term. And then you can see this in blue. So when the blue is above zero, that means that the equity did outperform. But if it's in red, that means equity underperformed. The thing that I think is fascinating about this premium is there are times, if you look at the 70s, where cash was outperforming equities for a decade. Like that's a very long time to underperform something that an asset class like equities that should give you much, much higher return than cash. But there are times where that's not going to be true. That's just the nature of the market. Then premium 2 is small cap stocks outperform large cap stocks. Again, we've been in an environment, especially in the last 10 years, that small cap stocks have had a really hard time. And that happened again in the history. And this data set is since 1932. And if you go back to the 1970s, the bigger the underperformance of that, the bigger the underperformance of small cap versus large cap stocks, the larger the outperformance was following that reversal. So we don't know when necessarily that reversal will occur, but if you look at the past 100 years, there's going to be cycles to that phenomenon happening. Then the third premium is value versus growth stocks. And value stocks have had, again, a very rough patch, one of the worst drought in the last 100 years. And you have to go back to the 1930s and 40s to see a similar underperformance, value versus growth. And again, the larger the when that happened, the outperformance was drastic. If you look at the late 40s and then in the 50s, so unless the market have fundamentally changed, that's also a possibility. But then new pieces of research will come out and will probably document that if that's truly the case. But other than that, the research is pretty well laid out as it relates to understanding where returns are coming from by looking at the characteristics of the companies within the market. And then lastly, this one I think is very common sense to me, is high profitability companies outperform low profitability companies. And you saw this almost pretty consistently across the board over the last, since the data set started in 1970. So let's look a bit deeper into the outperformance from small cap and mid cap, looking at a shorter universe. So just over the last 35 years, we can see this phenomenon occurring quite substantially, actually, 400% of small over large, and then twice, almost 1,500% of mid cap over large. And I have an interesting theory that I need to research more about this, but if you look at the universe between small, mid, and large, why would mid outperform substantially? And now this is a theory that I want to research more and dive into. But essentially, if you have a mandate that is forcing you to buy mid-cap stocks, you have to buy stocks that are too big to be small. So you need to buy low, and you have to sell the stocks whenever they became too big to be mid because they're now the large cap. So you're pretty much recycling. You're buying the strong stocks that came out of small that migrated to mid, and then you're selling them when they're too big to be mid when they go to large. And you're just recycling that. So I want to research this phenomenon a bit more to see if there's something more to it or if I'm just making this up. I just find it fascinating that as a mandate, there's this very rigorous buy and sell rules that are allowing mid-cap managers to being forced that small cap and large cap managers don't have, because a small cap, they basically have zero, well, depending on the minimum, but they have almost nothing to a certain, maybe 2 billion. And then large caps, well, they have a certain thresholds, say 5 or 10, and then they can go all the way to mega cap, but they don't have a selling rule where they have to sell those stocks. They need they need to have a certain target weights where they would start trimming those positions, because they wouldn't want that Nvidia or Apple to take 50% of their index, for example. So they would need to have position weights that trim those positions. But it's not necessarily they have to exit a name entirely similar to like a mid-cap manager would have, because that stock is just too big to be in their index. I just thought it fascinating. Also, the other thing that is explaining the, I would say, outperformance of mid-cap and small-cap is just that they just carry more risk. And I'm going to cover that in a second. But the more risk that you usually expect to take, the more return you should expect to earn as an investor. Otherwise, you wouldn't want to take extra risk if you're not expecting to receive extra returns. So there's no free lunch. Now, this is, if there's one thing I want you to take away from this presentation, I think is this slide, and along with the 5 principles. But this is over the last 20 years. If you look at the forward relative price to earnings ratio, so you take the P ratio of mid cap and you divide it by the P ratio of large cap, and you take the P ratio of small cap and you divide it by P ratio of large cap, you can see the valuations relative one versus the other. And right now we're at a position, given the underperformance that I mentioned in the previous slide, and because of the outperformance of large cap stocks, the small and mid cap stocks, even though historically they're expected to outperform, not only they're still expected to outperform going forward, but they're also offering you a very compelling entry point. Now, our approach here at Midden Wealth, and I don't have enough time to walk you through all of it today, but we're not timing like the entry or the exit or the exposure to one segment of the market or whatnot. We don't touch any of that. We have systematic exposure. We use model portfolios from various providers, but we use well-engineered portfolios that have systematic exposures to all the portions within the market. And there's no market timing involved in here. But if you had to look at historically when would be a good time to enter, this is one of them. But now let's look at, okay, you have all this information around the sources of expected return from equities. I mean, we've covered the market cycles, the different drawdowns, the recovery, and whatnot. So how do we put this together and see what kind of behavior should we focus on in order to have success and to implement the insights that I've shared with you today? So principle 1 is financial markets work efficiently. This sounds pretty simple. They are one of the best wealth-generating tools on the planet. And you would be surprised, maybe it's not people on the call, but you'd be surprised how the conversation with people is usually around reallocating their money so that they can take the appropriate risk to meet their goals, because people are extremely fearful of the market. And in my opinion, I think people are missing out on capturing broad market returns. And I'm not sure why. It's because of lack of education, the fear, many reasons. But I think people are working extremely hard for their money, but they're not making their money work as efficiently for themselves, which I found it super interesting. And nowadays, you can access global portfolios at a cheap cost, which I'm going to cover in a second. But like if you look at the history over the 100 years, again, growth of wealth, 1 month treasury bill, this is, think of it as cash, $1 grew to 22. $1 in the S&P 500 grew to 11,500 and change. $1 in US small cap index grew to 56,000, and $1 in US small cap value index, which is combining the sources of returns that I explained you in the previous slides around value and small outperforming large companies, then you grew to like 169. But those are indices. They're not, this is like reconstructed indices essentially to conduct research. They're not actual portfolio returns. But basically, the idea is to use investment managers that are following this approach and they're implementing this in the portfolios that are generating actual returns. The principle number 2 is to diversify your portfolio. And diversification can mean different things to different people. How we define diversification is when you look at something like 10,000 securities across 48 different countries, so that you don't have exposure to any one specific company or specific bond holdings or specific real estate. You're well diversified across markets. And the idea is to capture broad market returns based on the characteristic that I mentioned earlier. And as when I show you the global returns, no one is asking me to add more the India exchange within their portfolio, have greater exposure to the Taiwan exchange or the Nikkei and so on, right? So that's why when you have a well-engineered portfolio that is globally diversified, that's already capturing that for you. Principle number 3 is cost matter. This is, I think, very understood by clients. There are two primary expenses that you're paying when you work with an advisor. One is the advisory fee, which is usually about 1%. And the other one is the management expense ratio. And I can't tell you how many times I had to explain this to people. People think they're only paying 1%. No, they're not. As soon as they're sending me their portfolios, and I'm talking like people with $800,000, $1 million portfolios, the wealthier they are, the more usually they're invested in complex solutions and the higher the fees. I'm talking hedge funds, private equity funds, alternative investment, private credits. You can see 1.5%, 1.75% just on the investment cost. This is plus the advisor fee. So your total fee is well over 2.5%. And when you look at the average investment cost in Canada, investment fee is about, let's say, 1%. And then we can easily reduce that to 30 basis points. And there's solutions that are even cheaper than that. But sometimes going too cheap is not necessarily ideal. You have to find like the right balance. But at least thinking about this. And if you have, let's say, a $500,000 portfolio, it's close to $50,000 over a 10-year period that you're saving. So it's meaningful and it adds up. Now, I don't want to turn into a Questrade commercial here, but it's good to look at that. Now, principle number 4, it's all about risk and return. So there's really 3 components into your asset allocation decisions. It's either you're in cash. If not, you want a bit more return, you would be in fixed income, and then you'd be in equities. And in equities, I include real estate as well, which is usually a hybrid between equities and fixed income. But the more allocation you have towards equities, the higher the return you can expect, and the higher the volatility or the fluctuations in your portfolio. The lower your allocation to equities, the higher your allocation to fixed income and cash, the lower the return you can expect and the lower the volatility. There's no free lunch in the market. If someone shows me a portfolio that is up 50%, I guarantee you the volatility came with it, and the downside volatility is going to come down with it. And everyone wants upside volatility, but no one wants downside volatility. But it comes together. It's like a married couple. Then principle number 5, tune out the noise. And the industry makes it really, really hard. The financial media, public companies are reporting every 3 months, institutional trading desks and research desks at banks, active portfolio managers, hedge fund managers, they're always on the news about the next crash, the next short-term opportunity. I mean, Roaring Kitty, I don't know if you followed that. He went from 50 grand to 230, I can't remember how many millions. Yeah, it's insane. Like you have this every day, and it's very hard to block this. And I used to work for Thomson Reuters, which is right here. It's one of the largest financial news organizations in the world, and they were on the floor right above us. And I used to tour them sometimes and whatnot. They're always looking for headlines and for catches and whatnot, and to spike your attentions and to grab your attentions. And I really believe that without them purposely doing it, I think they've destroyed more wealth for people by instilling fear in their mind than anything else had ever happened in the market. And that's why people have become extremely fearful or are very reactive to what's happening in the market, because they're so in tune to every headline that is coming out. The hard thing is tune out the noise and stay focused on your asset allocation that is tailored to your goals. It's simple, but it's not really easy to implement. Now, once you start implementing that, what's the whole point of why are we doing this? The goal is to have greater peace of mind around how your money is invested, because you know that it's based on research and it's well engineered and it's in line with what you want to achieve. And even our riskiest, I would say, portfolio are still medium risk in terms of scale. And usually this is enough for the vast majority of people, because most people don't even capture broad market returns because of their in and out or their behavior, or they're cashing out at the wrong time. So just capturing broad market returns is hard for a lot of people. And And then the goal is to, so that, and having a plan, I'm going to go that in a second, but having a plan so that you can spend today and live experiences today, and then save what you need in order to ensure that, you know, your retirement is safe for, and all any other goals that you may have. So like, I'm huge about goal settings and living life to the fullest, but also while planning for tomorrow. So that's the last few slides here, is just to share with you our kind of model and how we work with clients. Like I mentioned, everything we do is around a goal-based framework. So when you work with us, you'll have a concrete plan that shows you like, how can you accomplish your goals? Like, you'll have an action plan. Like, what is the to-do list like that you need to implement around tax, retirement, tax, and or investment, insurance, and estate planning strategies that will get you there. And ultimately, what I find is we give confidence to people that they're going to be okay, that everything has been thought of. It's been supported by data. It's been supported by research. The planning that we have, the tools that we use, is supporting this specific strategy. And that's giving you a lot of confidence that, you know, based on your unique situations, which is different than someone else, that these strategies are going to help you, you know, save on taxes, build a greater legacy, spend more today, spend more in retirement. And when you look at the investment plan, we keep it very simple, and we focused on academic, you know, research that I mentioned today, as far as where are the sources of returns in the market and being exposed to them. It's not like there's a bet on a certain part of the market versus another. It's a broad exposure that most people don't have. Most people are very concentrated either in Canada or large cap stocks. So we try to broaden this and give them a broader exposure so that we can capture different streams of returns over the long term, depending on which one is outperforming. Because like I showed you earlier, there are fluctuations. Sometimes growth stocks will outperform, sometimes value stocks will, and so on. It's a personalized asset allocation specific to your goals. So the asset selection or the investment selections within the portfolios are not going to change from client to client, because the market opportunities are no different between me and a retiree. But the allocation and exposure that I have versus someone who's retired is very different. That's where the customization comes in. And I think that's where people get this wrong. They're trying to customizing the investment selection because they think one person is very different than the other. We take a different approach. The asset allocation is different, but the investment opportunities are very much the same. And then having a risk management plan based on different scenarios. What if there's a market crash, like another 20% decline? Are you going to be fine? What if this happens the first year of retirement? What if there's high inflation? What if there's lower returns, or you live longer? How is your plan going to succeed in these scenarios? And then last but not least, it's the coaching, and ultimately it's the accountability, whether it's 3 months, semi-annually, or once a year, having or ad hoc, depending on, you know, your life circumstances and how much hands-on and planning you need, is having the accountability that, you know, to sticking the strategies, you know, whether it's a saving strategy or a spending strategy or an investment strategy, and having the accountability there to ensure that you're carrying through with what we recommended and that you're succeeding, to have the highest probability of you succeeding. So there's 2 paths that you can use to hire our services. If you want to invest your money yourself and you just want a financial plan, you can retain our services. Our prices are $2,000 for employees. This is for you and your spouse. And it's $3,500 for incorporated business owners, for you and your spouse as well, plus taxes. And you're going to get 5 meetings with our team. The first meeting is around goals and values. So we'll go in depth as to what's your past experiences around investing, and how has your past experiences around money is shaping your beliefs around money today, and how this is driving every financial decision that you're making. And we use this, or I use this, as a foundation to build financial planning strategies and investment portfolios, because even there's still some customizations that I try to do with investment portfolios based on the client specific situations. Like, for example, I did a plan for someone who worked at one of the large tech companies, and I incorporated quite heavy tech exposure in his portfolio, in addition to a well-engineered portfolio, because that's just naturally what I believe he would stick with over the long term. That's what I recommended him to do. And he's a DIY, and then he took that, and then he's going to look into incorporating small cap stocks and stocks with higher profitability and so on, right? Which is also another thing. When people want to try to do this on their own, I see it. There's a lot of, it's not impossible to do, but it's not that simple. And there's a lot of things that needs to be looked for. It's not just like adding a small cap ETF to your portfolio. There's a lot more to it, but it's giving them some insights as to what to look for. You know, if people want to do it themselves, I respect that. Then, okay, so the goals and values, the data integrity, then a financial plan presentation, and then you'll have a complete investment portfolio analysis and recommendations. You know, what you should look for, what you should improve, and what you should include in your portfolio too, or what kind of asset allocations you should explore in order to meet, you know, short-term goals, medium-term goals, or long-term goals. And then an insurance analysis. You know, are you overinsured, underinsured? And this is usually based on your preference as well. As much as your human capital, you know, where you are in your stage of life, how much financial capital you have, and then how much risk do you want to retain yourself, or do you want to offset to an insurance company? And then the other part is, if you want to look for a team that really handles everything for you, that's where we use a fee-based model. And this is our fee. So it's 1.25% on assets for less than $1 million and 90 basis points for assets greater than $1 million. As I mentioned, our investment portfolio costs about 30 basis points and change, which is a third of usually what the industry offers. So in total, you're looking about 1.57%. And this includes everything that I mentioned, you know, all aspects of financial planning, cash flow planning, retirement planning, investment planning, tax planning, estate planning, insurance planning, all based on your goals and your values, as well as all the check-ins and the coaching. So this is how we... those are the offering that we have for clients. And if you have any questions or comments, please feel free to reach out. I know I share my contact details at the beginning, but the clients that we work with, you know, I work with personally, they're quite varied: employees, business owners, pre-retirees, retirees, people with strong values, and the delegators, people who want to offload this task to someone that they trust because they have an expertise. You have an expertise in a different domain, and you want to focus on your business, you want to focus on your career, and you want to have an ally in your corner that will help you make more informed decisions throughout your lifetime as it relates to your finances, your investments, tax situation, the legacy that you want to live, and so on. So yeah, please feel free to get in touch if you have any questions, comments. It's been a pleasure to start this webinar on financial markets and US elections. Have a good rest of your day. Bye-bye.